And we will be now moving on to our keynote address centering around building macroeconomic resilience in a world of trade shocks. And this keynote address will focus on high impact insights on Sri Lanka's macro trajectory. And it is my duty to introduce our keynote speaker, Dr. P. Nandalal Veerasinghe, who is the 17th governor of the Central Bank of Sri Lanka. He has been rated A-grade central bank governor in the years 2023 and in 2024, respectively, by Global Finance magazine based on inflation control, economic growth goals, currency stability, and interest rate management. He also received the award of Sri Lankan of the Year 2024 from LMD, that's the Lanka Monthly Digest Business Magazine. I would now like to invite our keynote speaker, Dr. Nandalal Veerasinghe, Governor of the Central Bank of Sri Lanka, to deliver the keynote address on Sri Lanka at the crossroads, navigating trade turbulence, currency risk, and the global reset, which is the theme of this year. And the keynote address will be on building macroeconomic resilience in a world of trade shocks. Over to you.
Good evening, everyone. The chairman, Sampath, Mr. Amarsekara, distinguished panelists, all the distinguished invitees, ladies and gentlemen. First of all, let me thank the Sampath Bank for inviting me to deliver this keynote address in a very timely topic, the theme, that is building macroeconomic resilience in a world of trade shocks. I think very timely topic. Given the challenges and opportunities we face in the context of a rapidly evolving global economic and geopolitical landscape, I think the chairman already alluded to some of the ideas that I'm going to elaborate more in my speech. Today, the global environment is being, as we know, reshaped by heightened geopolitical tensions, resurgence of protectionist policies in terms of trade, especially, and shifting patterns of global trade and finance both. These developments carry profound implications for us, Sri Lanka, Sri Lanka's ongoing economic recovery, the stability of our macroeconomic framework, and the strategic choices we must make to secure long-term sustainable growth, which is very important for all of us. As we consider these dynamics, it becomes clear that Sri Lanka's progression must be anchored in strengthening our macroeconomic fundamentals, ensuring that our economy can withstand external shocks while continuing to advance towards our development goals. Let me begin by briefly outlining where Sri Lanka stands today on its path to recovery and the domestic economic outlook before turning to how we can strengthen our buffers against external shocks, which is relevant to today's topic. So on the path to recovery and the outlook of the economy of Sri Lanka, since emergence of the economic crisis in 2022, Sri Lanka has made a remarkable turnaround. The government, along with the central bank, with the support of the IMF Extended Fund Facility arrangement, and in close collaboration with creditors and the broader international community, Sri Lanka has embarked on an ambitious program of macroeconomic stabilization and structural reforms. The goal was not only to recover from the crisis and restore macroeconomic stability, but also to lay the foundation for a stronger, more resilient, and more inclusive economy. So we have a lot to do going forward. Consequently, the Sri Lankan economy broke the six-quarter streak of contractions in the second half of 2023 and has recorded positive growth since then, reflecting the resilience of the Sri Lankan economy. Leading indicators signal that this growth momentum is set to continue, underpinned by strong macroeconomic fundamentals. Accordingly, this year we expect to achieve a growth of around, in our estimate, projections, 4.5%, which is higher than some of the other agencies' projections, but this is what we have announced in our monthly policy report a couple of weeks ago. So turning now to important part of the central bank, which is monetary policy. The core responsibility of the central bank, I must emphasize, the significant progress we have achieved in restoring price stability. At the height of the crisis, inflation reached unprecedented levels. We all felt the difficulties at that point. Yet, through the implementation of exceptionally tight monetary conditions, we succeeded in bringing inflation down to single-digit levels within 1 year. A record phase of disinflation, unmatched in recent global experiences under similar contexts. Since then, we have maintained low and stable inflation. Recent period of deflation is largely a result of administrative price adjustments, particularly in energy and petroleum. With the stabilization of inflation and anchoring of the inflation expectations around the target, which is 5%, the central bank has shifted to an accommodative monetary policy stance. Since mid of 2023, our monetary policy decisions are guided by a robust, data-driven and evidence-based framework that takes into account current inflation, inflation outlook, potential outlook gaps, the balance of payments, external vulnerabilities, and the accumulation of external buffers, and also monetary policy buffers. This disciplined approach has also helped anchor inflation expectations, a crucial factor for long-term stability, which is most important variable for any economic stability. Looking ahead, we expect inflation to return gradually to our target range, which we are mandated to target 5% inflation. So we will be reaching that around mid-2026 with improving demand conditions with the recovery. The current deflationary phase is now coming to an end and was temporary, and the robust economic growth recorded during this period suggests that this deflation has not been harmful for economic growth. On the other hand, since we are emerging from a high inflation episode, this marginal reduction in general price levels provides some respite to the general public. As economic activity continues to strengthen, prudent monetary policy will ensure inflation remains within the stable target range, thereby safeguarding macroeconomic stability and also supporting sustainable long-term growth. An important milestone in Sri Lanka's economic recovery is the return of the current account to surplus in 2023 for the first time in few decades. The current account of the balance of payments, which is external balance of the country, recorded a surplus reflecting a strengthening the external sector conditions. This positive trend has continued with external sector performance showing resilience so far in 2025 despite heightened global policy uncertainties and also relaxation of all the controls on imports that we relaxed this year. We are therefore on track to record a surplus this year as well, which would mark the 3 consecutive years of current account surpluses, an achievement unprecedented in recent history. I think this is kind of turning into the twin deficit story into a twin surplus in terms of both fiscal primary surpluses and all the current account surpluses. The structural change in our view is the economic management. At the same time, we have rebuilt our foreign exchange reserves from critically low levels to a little bit more comfortable levels, now exceeding $6 billion, but still we need to build more, while ensuring that the service obligations are met without disruption. That is important because we had to face this sovereign debt crisis in 2022. Most importantly, these improvements in the external sector have taken place under what we call a flexible exchange rate regime under the new monetary policy framework. As part of our monetary policy framework, that's one important is the currency risk. We remain firmly committed to maintain a flexible exchange rate regime under flexible inflation targeting framework. This is a fundamental basis for the monetary policy implementation in Sri Lanka now. Under this policy, the exchange rate will be determined largely by the market forces. One can go against the market forces, while allowing the central bank to intervene in the domestic foreign exchange market when necessary only. Our interventions are transparent and aimed primarily at 2 objectives: to build foreign reserves and to prevent excessive intraday volatility in the exchange rate. This is very important for business to understand the framework for exchange rate determination, for them to be able to have a predictable businesses going forward. The Sri Lankan rupee, which strengthened considerably after the deep depreciation in 2022, uh, cons- appreciated in both 2 years, 2023 and 2024, has now become a more stable currency compared to the past. While this year we have seen a modest depreciation against the dollar, US dollar, but dollar, although is stable against dollar, global currencies are much more volatile. There's much more volatility against the dollar. There's nowhere there's a fixed currency. Any currency is volatile against the dollar. The path of the exchange rate remains clear and stable, underpinned by healthy inflows and stronger confidence. This movement is consistent with market fundamentals, including a pickup in import demand, and has been orderly and manageable. Looking ahead, flexible exchange rate regime will continue, ensuring that exchange rate movements remain consistent with economic fundamentals, thereby supporting stability, resilience, and growth in the medium term. I would say it's consistent with macroeconomic fundamentals. So exchange rate is an outcome of stable macroeconomic policies. If macroeconomic policies are unstable, then you can't expect a stable currency. Let me also highlight the process, the important progress. Important part of the macroeconomic stability is the fiscal front. That has been a weakest point in several decades in Sri Lanka. Weak fiscal performance has long been at the core of Sri Lanka's macroeconomic imbalances. We all know that. But over the past 2 years, we have seen encouraging improvements. The fiscal deficit has narrowed considerably, with primary balance moving into a surplus territory. Revenue mobilization has increased significantly from low 8% in 2022, close to 15% this year. At the same time, adoption of cost-reflective pricing mechanism, that's another important reform, has enhanced financial viability of state-owned enterprises. Looking ahead, the government remains firmly committed to a revenue-based fiscal consolidation, supported by the broader reform agenda under the IMF EFF program. Since much of the tax policy reform has already been front-loaded, the focus in the period ahead will be on strengthening tax administration and expanding the tax base to ensure stronger and sustained revenue growth. Then this will facilitate to have a more stable, lower the tax rates going forward once we have a more broader tax base going forward. Now let me turn into financial system stability, which is other important mandate and objective of the central bank. Is part of the banking sector as well, which remains one of the foremost responsibilities of the central bank. Despite the extremely challenging macroeconomic environment over the past 2 years, the stability of the financial system was never compromised. At the height of the sovereign debt crisis and also balance of payment crisis, when concerns were raised about the exposure of state banks to sovereign debt and the deterioration of asset quality in the overall banking sector, there were fears of a possible banking crisis. A lot of people had a lot of concerns on the possibility of a run on the bank and a banking crisis, which would have been the most difficult path to recover. And if that happened, we would still be basically suffering if that happens. Luckily, or thankfully, we have been able to maintain without any possible banking crisis. Those fears, the fears of banking crisis, did not materialize thanks to the proactive and prudent regulatory measures that we adopted and the close engagement we maintained with the banking sector to strengthen its resilience. Today, we can say with confidence that the financial system has weathered the storm, with key indicators such as capital adequacy, liquidity, and asset quality showing steady improvements that we all know. During this period, we also introduced very important reforms to strengthen all this the bank financial stability, including first one is amendments to the Banking Act, alongside enhanced regulatory and supervisory practices, which has strengthened central bank ability and empowerment, have much stronger and prudent regulation and supervision of the financial institutions. Banks and non-bank financial institutions that we regulate were provided with regular guidance on capital and liquidity management, while asset quality reviews of large banks were also conducted. I'm sure ADB supported a lot in this area during the crisis period. Looking ahead, with the conclusion of the debt recycling process, the government's debt service burden will ease significantly, placing the banking sector in a stronger position to support the economic recovery going forward. The central bank will remain steadfast in safeguarding financial system stability, our other key objective, while further structural, legal, and policy reforms will be mobilized to strengthen resilience. With adequate capital and liquidity buffers, the financial system will be right now well positioned to finance growth and extend greater support to businesses and households with confidence. Now let me turn into the important other part of the theme, which is the navigating global headwinds. It's the current challenge that we are facing. We are now restored a degree of macroeconomic stability, and the foundation for recovery are clear in place domestically. Yet, we transition from stability to a sustainable growth, we must recognize that our path ahead will not be without challenges. So we never know when there will be a next external event or the shock. We are entering a global environment shaped by escalating geopolitical tensions, rising protectionism, leading to a geo-economic fragmentation and rapidly evolving patterns of trade and finance. All the financial flows and trade flows now are going into different directions. These developments carry important implications for our recovery, stability, and future economic strategy, and we must be prepared to navigate them with resilience and foresight. Protectionist policies are gaining renewed momentum at this point across the globe. We are particularly concerned about the impact of obviously US tariff, given that the USA is our largest single export destination, accounting for nearly 25% of our total exports in 2024. However, through active engagement with our US counterparts, we successfully negotiated a progressive reduction of tariffs, initially from 44% in 2nd of April to 30% subsequently, and now 20% from August 2025 onwards. Since these tariffs are applied across the board, and our competitors will also face similar tariff rates in different proportions, we do not see a major risk at present through the need to diversify into high value-added niche products remains, though the need to diversify into high value-added niche products remains important for long-term competitiveness. All this short-term we don't see a thing, but we need to remain diversified going forward to maintain our competitiveness. Limited product and market diversification in trade has been a long-standing vulnerability in Sri Lankan economy, and the recent US tariffs have underscored the necessity of moving beyond our comfort zones in relation to trade promotion, trade diversification that we have been talking several years and decades, but it has not made good progress. Now, this is a time when we should start doing that. Although Sri Lanka faces limited direct impact from rising tariffs, indirect impacts could arise through broader global economic disruption. Rising tariffs could disrupt the global disinflation trend, triggering renewed inflation pressures while weighing on investment because of the uncertainty, trade, and overall growth of the global growth. Tariffs on key inputs such as raw materials and commodities may fuel price volatility globally, while uncertainty around trade policies risks holding back business confidence and investment decisions worldwide. At the same time, geopolitical instability, especially in the Middle East, has further uncertainty. Escalating conflicts threaten maritime security, raising shipping costs, and creating bottlenecks in the global supply chains. Hopefully, in the new global order, these geopolitical tensions will settle or at least reduce going forward. Combined with the potential global growth slowdown and tighter financial conditions, these risks highlight the importance of strengthening resilience of the domestic economy, in our economy, through prudent macroeconomic management, diversification of markets and products, both goods and services, and deeper engagement in international cooperation with our partners. So what is the way forward to build that buffers and resilience? With stability now restored, we have entered into a new phase where the focus must shift towards building resilience, and sustained growth. The successful progress under the IMF program, alongside the substantial completion of debt restructuring, has provided Sri Lanka with a strong and more predictable foundation and space than at any point in recent years. Debt servicing has resumed, macroeconomic stability has been regained, and structural reforms are underway, all of which have begun to restore investor confidence and create a more certain environment for businesses and also households and the government as well. But we must recognize that stability is not an end in itself, but it is a platform and foundation upon which we must now build a more shock resilient, competitive, and inclusive economy. This calls for unwavering commitment to reforms, sound fiscal discipline, and a policy framework that attracts investment, empowers private sector, fosters innovation, and equips the economy to withstand the uncertainties in an increasingly turbulent global landscape. Building on this foundation, we will now turn to how Sri Lanka is preparing to navigate external risks and to ensure continuous resilience. External shocks, whether from trade disruption, shifts in global tariff, or unforeseen crises such as pandemics, are beyond our control. So no one knows what will happen, so we have to prepare for that. What is within our control, however, is our preparedness. This is why we have placed strong emphasis on building resilience through multiple buffers that can be mobilized when needed. This is a hard-learned lesson that we had during the crisis period. We ran out of all the buffers. We had to go through a very difficult, adverse economic cycle. In terms of external buffers, one of the important buffers that we need because of balance of payment issues, we have strengthened our international reserves. We are in the process of strengthening further, which now serve as a vital shock absorber, bolstering market confidence and insulating the economy from global volatility. Importantly, unlike in the past, when resources are built on foreign borrowings, the reserve accumulation at present is organic, driven by current account surpluses that country has generated, supported by healthy inflows such as remittances and tourism, and continuous expansion of export. This creates a more stable and sustainable reserve position, reflecting the progress we have made and a stronger foundation on which the economy now stands. Central Bank, we now is committed to build external buffers further, especially in line with the commitments that we have agreed to, committed for the future. We are also in a strong position with respect to monetary buffers. That's one important part is the monetary policy space that we have built up. Our monetary policy remains forward-looking, guided by the outlook for inflation and growth, as I mentioned earlier. Inflation is firmly on track to reach close to our target level within next year, while growth is also projected to be closer to around 4.5% this year, and we hope that will continue in coming years. However, if external shocks were to impact the domestic economy, now we have a space to respond from monetary policy. On a forward-looking basis, with inflation at 5%, if we have reached the target, the policy rate at 7.75%, we currently maintain a positive level of real interest rate about 2.75%. In my view, it's a good space, good buffer to have, giving us ample room to adjust and provide support to the economy should the need arise. On the fiscal front, it's another important buffer that we need to maintain by the fiscal authorities. Strengthening buffers requires firm commitment to revenue-based fiscal consolidation, alongside the reforms of state-owned enterprises. It's not only the fiscal policy, but also the state-owned enterprise reforms. A stronger revenue base achieved through broadening the tax net, improving compliance, and modernizing tax administration is essential to ensure the path ahead, also debt sustainability, improve fiscal space, and boost investor confidence. At the same time, the implementation of SOE reforms, especially cost-reflective pricing, has eased the burden on the Treasury and the taxpayer and reduced the need for direct financing of loss-making state-owned enterprises while encouraging these entities to operate on more commercial terms. Going forward, continued SOE reforms, together with sustained revenue mobilization will be critical to ensure that public finances remain on a stable path, freeing resources for priority investment and enhancing resilience against future stock. I'm sure in the panel discussion, Murtaza will talk about this has been involving a lot of SOE reforms even in the past. While building buffers is essential to safeguard against external shocks, it's equally important that we proactively seek out the opportunities that such global shifts can create, particularly in trade. In the current context, the global tariff tensions, trade diversion could present a significant opportunity for Sri Lanka. I think we should see this as an opportunity, granting great access to key markets like the USA and EU, where we compete with our regional peers like India and China, and also others in the region. Our niche strengthens, particularly in high-end garment manufacturing and other specialized exports, and also high-end services, give us competitive advantage, while our market-driven private sector has the networks and capabilities to adapt swiftly. On the other hand, what's other important is that trade diversification is one of the most effective strategies for reducing vulnerability to global trade shocks. By broadening its product range and exploring new markets, the country can mitigate its risks from relying heavily on just few sectors for trading partners. Currently, Sri Lanka mainly exports, we all know, apparel, tea, and rubber products, which are essential but make the country vulnerable to downturns in those industries and also the markets. Emerging sectors such as information and communication technology, the services, maritime logistics, tourism could considerably boost export earnings, and also within the manufacturing we can move up the higher value-added chain. On the market side, expanding into different regions is just as important. Currently, nearly half of Sri Lankan exports go to just 5 countries. Connecting more deeply with the regional trade deals is one of the concerns and this negative perception we had in Sri Lanka on the opening up the markets for trade. The regional trade deals and Asian markets that could make the economy more resilient. Participating in mega regional trade agreements like the RCEP can give access to faster growing markets and boost investments. Building stronger trade ties with other regions could also help diversify away from traditional Western markets. And also the other markets are also now growing faster than the Western markets. That could provide opportunities with the diversion of trade. Clearing the way for smoother trade is just as important as finding new markets. So clearing the way for smoother trade, not only the markets, but also you have to do a lot of internal reforms in terms of customs and all the other trade facilitation areas. Thereby cutting unnecessary tariffs and reducing barriers such as complicated customs procedures, licensing requirements, and also reducing trade barriers, para-tariffs and other trade barriers, and also reducing all the strict standards that we are having currently. On the other part, the important one is the debt sustainability, especially sovereign debt sustainability is equally vital to ensuring long-term economic resilience. It requires a prudent, transparent, and forward-looking debt management strategy that diversifies funding sources while minimizing resilience on borrowing. That's where there's another important reform. The Public Debt Management Office is now established, a new office. We hope that this new office can continue to do and have a much more prudent debt management going forward, especially sovereign debt management. With a persistent external financing gap, mobilizing non-debt creating flows such as foreign direct investment is also a crucial part of this strategy. This calls for sustained efforts to strengthen the investment climate by streamlining regulations, reducing policy uncertainty, and enhancing competitiveness. The World Bank's new Be Ready Index, that's a new index, also highlights the importance of a sound regulatory framework, effective public service, that's also very important in Sri Lanka, and operational efficiency in attracting and retaining investors in Sri Lanka. At the same time, as I mentioned earlier, improving financial performance of state enterprises and providing opportunities for the diversification is also other important reform, which is essential to reduce fiscal pressures and avoid crowding out private investments, thereby freeing up more resources for the productive economic activity that we are seeing already happening with the private sector credit now growing faster with government sector, state-owned enterprises now repaying their debt obligation to the banking sector. Alongside debt sustainability, strengthening our institutions is fundamental. A strong institution is necessary, a strong element in any strong, resilient economy. This is to build lasting economic resilience. Good governance is the bedrock of stability, fostering the trust and confidence needed for long-term business planning and investment. Recent reforms, I think, can share this. I'm sure panel will discuss in detail. Reforms such as Public Financial Management Act, Public Debt Management Act, and the Anti-Corruption Act. These are pivotal steps in enhancing transparency, accountability, and prudent financial management, both the sovereign and as well as the private sector. The significant milestone in this journey is most important one for us, for Central Bank, was the passage of the Central Bank of Sri Lanka Act in September 2023. I think I should talk about it, which enabled the formal recognition of flexible inflation targeting as Central Bank's monetary policy framework. And most importantly, this reinforced the independence and accountability of the Central Bank, the monetary authority. By restricting monetary financing, strengthening accountability to the Parliament and the public, and ensuring monetary policy decisions are free from fiscal interferences and fiscal dominance, the Act has enhanced both the governance and credibility of monetary policy in Sri Lanka. At the same time, strong anti-corruption frameworks, together with transparent procurement and enforcement mechanisms, are also essential to protect public resources and improve investor confidence, to create level playing field for businesses and reduce systemic risks. So in conclusion, Sri Lanka has rebounded faster than expected compared to some other markets that went through this difficult situations. And the foundations of macroeconomic stability are now firmly in place. Yet the path ahead is reshaped by global uncertainties, trade shocks, as already we talked about, and evolving geopolitical dynamics. As we transition from stability to sustainable growth, building a strong and more resilient economy will require continued collective efforts from monetary and fiscal authorities, the private sector, and all stakeholders here. External risk preparedness is more critical than ever, and strengthening resilience will rely on building robust fiscal, monetary, and external buffers. At the same time, continuing the reform momentum will be critical to boosting the country's long-term growth potential, as well as to maintain debt servicing capacity to ensure economic sustainability well beyond the IMF program. This is the mistake that we did in the past, doing something 2 steps forward and taking 1 step backward. That's not the way. We need to continue this reform momentum going forward. Together with foresight, discipline, and collaboration, Sri Lanka can navigate global uncertainties successfully and emerge stronger, more resilient, and well-positioned for sustained prosperity going forward. Thank you very much.